And with me today is the amazing Mike Arndorfer. And we have a new guest, Kaley Kris. Just a little background before diving in. Mike is the founder of A2 Passive Coaching. That's where he helps LPs and GPs be better operators and investors. And Kaley, who's just joining us, she's an awesome portfolio manager whose day job is to professionally analyze alternative deals like the ones we do. Aside from that, we've all done a lot of private investments. If you're interested in learning more about Mike and Kaley or me, just check out our contact info in the show notes. For recap, each episode, we walk you all through pitch decks that were submitted by GPs who gave us their consent to do this public review. That's really important. And our only objective here is to help you all become better passive investors and choose the best deals to invest in. All right. So without further ado, you guys ready to dive into the next deck?
Yes.
Yep.
Awesome. This is a deck that was submitted by Nomad Capital. I've actually met these guys a few times at some of these conferences. Mike, I think you have as well, right?
I did.
And they seem like good guys, but let's see what the deck has in it. All right. So just for context, these might be decks that people submitted like a while ago. I don't know. We don't know if they're raising or not raising. It doesn't really matter. What matters is like, let's go over it and get insights on like what we like, what we don't like, what we think we should ask the GP based on this deck. What are the red flags and all that? All right. So high level, diving into it, focused on self-storage and, high growth markets, whatever. It sounds like it's a fund, right? That they're looking, at least from the get-go, looking to acquire multiple properties that are in self-storage conversion to put into the fund. We're good?
No, the only thing on this one, so self-storage conversion, so they'll tell their story more later with that, but it's not, so it's sort of that play between a little higher level of construction and stuff than the typical value add, but not the full development. So that kind of tells you the sort of that risk appetite that you're going into. And then the other thing that's unknown at this point is 30 million, is that the amount they're raising, which it doesn't look like it is. It looks like they're raising more like 10, but that's the total size of the fund. And they're hoping to put 4 to 6 properties into the fund overall. We'll find out later that they've got the first couple identified, which is always nice in a fund. So then you can circle back and find out more about those.
Right. I mean, again, there's not much information here, but that's a good point. Kaley, anything you want to add or should we move on?
Yeah, well, and I would just say I always like, before I dive too deep, to do a little background industry research, because I think that's always helpful to see if you even like the space. And I think within self-storage, it's a really interesting, popular space right now that, especially kind of post-COVID, has gotten a lot of popularity. And so this is an interesting, unique play on it. As you said, the self-storage conversion rather than development or just pure acquisition is definitely interesting. But I think something to, as we go through, look out for is it is becoming a more competitive space. And so that is definitely something I keep in the back of my mind before I dive too deep.
Right.
Hey, Kaley, what do you think on, sometimes there's things like this where they say high growth market. How much do you kind of hold the sponsor to what they're saying? Because they do give us a couple ideas of markets they're in and the first couple that they're going into later in the deck. I don't know those markets real well, but they don't in my mind, they're not like, oh, of course, that's a high growth market. What do you think on that? Where they kind of make those comments? Do you hold them to it, or do you just kind of judge it as you go?
Yeah, I think I take those with a grain of salt. Everyone's going to say they're going into high growth markets. It would be very strange for someone to not say that, right? Because why would you be going into those markets then? So I do take it with a grain of salt. I think that also the definition of what that means can be different for different people. So is this something that is just starting to go into a growth mode, and by whose definition? So I always take it with a grain of salt. I do really like when they provide true examples, and especially something like this that is only 4 to 6 developments. I try to dive a little bit deeper into, what does your pipeline look like, so I can get a better idea of what do you actually mean by that.
Exactly.
Let's dive in because we're still at the first slide here. Yeah, but that's great background. All right. So disclaimers about the team. It's a family-owned business.
Yeah, I would love to have a bit more background on what the actual experience is. 40 years of commercial and residential construction and 30 years of self-storage. It is pretty broad. Doesn't actually give us a lot of information about what each person's role has been in those past kind of track records and how relevant it is to this exact strategy. So definitely would like to see a little bit more info there.
And the track record is also important for that. We'll get to that at the end. But I do think the fact that they do mention, and we've seen other decks where it's been broader than this. And this is actually specific when they talk about if it's a self-storage play, and they're saying they did 130 million in building self-storage. I do think that does say something to the point you just mentioned. I don't know, Mike, what do you think?
Well, that was one of the things I was going to comment on. So it says 130 million in assets under management in self-storage. When I start doing the math, once I'm looking at their portfolio later in other decks, it's kind of hard for me to come up with those numbers with the examples they give on the size of their portfolio. And it looks like they have 9 properties before this fund. So I'd want to ask that. Are you managing for other people? Or how did you come up with that valuation? Because this is where you're trying to come in and decide how much experience does this team have doing exactly what we're doing. And then you want to make sure that those assets that they have done are similar to this. And if they're not, you're just taking on a little bit more risk. And like Kaley said, you have to know that they have the experience to do it.
Right. And it does seem like they have a fairly sized team as opposed to other teams we've seen.
Yeah, I would say we'll get up to this on the next slide, but because this is vertically integrated, this actually may look like a pretty small team, depending on what they actually mean by the vertical integration, because they're doing all stages of this development management. So a lot of the people, especially on the right side of the page, are going to be more your day-to-day operators rather than the actual investment team and the investment management side of things.
Right, but on the bottom, the vertically integrated part of the property management, like they have a team that all they do is like the day-to-day operations.
True.
The other thing that this can tell us is since they have 9 assets now, you can see that what they've done is kind of batch things. So it looks like they have a model where a lot of times you may have one manager for the property, or you could have one manager covering a couple if they're closer. And that's just one of those things you want to come into, because this is a 10-year project. And so you've got, the construction part, the buying it in the beginning phase, but then they're going to be running it for quite a while. And you want to know how good is their team? Do they know how to do this? And I would want to find out some specifics that they don't give us later, but I would want to know, like, how are these other projects going?
Kaley, I'm curious from your experience, like, do you see usually when it's a vertically integrated development play, like which part of the team is usually bigger?
It is typically the actual property management and operational side, because that's just a bit more intensive and you can scale easier on the investment and asset side. And really, once those are established, constructed, it just goes off to the property management team. So they do a lot more upfront work on the investment team and then pass it off. So you definitely see smaller investment teams, but you want to make sure that they're still there, can still manage the exit and ongoing management of that, as well as source new deals, because you assume their go forward plan is to continue doing this kind of strategy.
Yeah, and this is what they're vertically integrated, right? With the acquisition, the construction, and the in-house management. We've talked about this before in multifamily world of like, is it good or is it advantage or disadvantage to be vertically integrated? What are your guys' thoughts on this for self-storage? Like, I haven't heard many operators that are vertically integrated in self-storage from acquisition to property management. What do you guys think about that, or no thoughts?
I would agree with you. I don't see a lot of people self-managing at this size. Usually they're a little bit bigger. And so that would mean that these guys probably either want to be very hands-on or they're trying to grow, would be my guess. The thing that does help them is they've got a couple scattered sites, as we'll see later, but a lot of it is fairly concentrated. And so that does help to be able to self-manage things, because they're just doing in one region of the country.
I would agree that there's some pros and some cons here. I've really dived pretty deep into this when any firm is vertically integrated, because the fees and cost sharing may not be as advantageous as if you're going to a third party and getting market rates. So I definitely like to dive in pretty deep there, see the allocation of different costs and fees that go into this, and then make sure that the team in these different, sectors have the right experience and can be as efficient, because sometimes you pay up a little, but it's a higher quality third party manager. But I think within self-storage, I agree, you don't see this a lot, but it is also not uncommon for a lot of these smaller managers or even just families to own a lot of these and self-manage. And so the one good thing is that for the exit, a lot of the larger managers like to go in and optimize and really create a more established, higher tech and more efficient management program. But it is a little different for the smaller size.
A side note that has nothing to do with this deck, but I think is an interesting thing. Another sponsor that I have invested with in self-storage, they were self-managing everything on a pretty big portfolio. And then they decided to sort of a public company. They were sort of creating a little bit of a friendship with them, sort of letting them see what things were like, and had them take over a bunch of properties and to have them start managing. Because most of the time, if things are set up right, your sponsor isn't making any money on the property management, they're just breaking even. And what they found after a year or so of that was that in the bigger markets, the other outside managers were actually able to do a little bit better than them. But they ended up having to take back all the properties that were in these small little markets because the outside manager just really didn't have the ability to understand and manage in a very small environment versus the sponsor themselves did. And so that was just a interesting side note that I found from that. But there's kind of pros and cons.
By the way, also, when you look at this slide and you see each of these parts of the business, visions or whatever, different companies, it seems like they're their own brands. So the construction is a brand, PropCo is a brand. And if it's a brand, that might mean they also service other operators.
And this is where that, like on the first slide, they were saying 130 million assets under management. When I look at this and I see that city in-house management with over 5,000 units, that makes me, that sort of like tells me then that they are property managing for other people, because I don't add up their number to 5,000. I get something probably in the neighborhood of about half that. And so then that lets you know that they are doing other people.
I'm not saying it's a bad thing, by the way. I'm just saying it's a question to ask. I think I'd ask the operator, listen, are these guys also? And if they are, to your question, Kaley, about the fees, like, all right, then let's see, what are you charging other operators, more or less? And then let's see, and again, this goes back to the fundamental aspect question is like, what is our confidence in this operator presenting deals as is, like the trust aspect, which is the most important aspect whenever we go through these decks and we want to invest with someone. And so anyway, this is a really good way. If it is used as a third-party contract or a third-party PropCo, then it could be interesting to dive into those numbers, just get more confidence. The numbers, the perform of the biz plan makes sense. Let's move on here. So this is their offering summary, high level, what they're looking to add to the fund, right? Converting retail, Southeast U.S., yeah, I don't know if the 19 to 22, are they talking about this on the property level, on the fund level, or to the investor?
And this is probably the first slide of many that they just don't give us enough information. There's a lot of things I really like about this, but I found myself very frustrated reviewing this deck because it's like they're giving me things, but they're not giving me the right things. It's like they just don't know what we need to be able to analyze it. I don't know. It was one that seems like a pretty advanced group, but they just haven't figured out how to present what they need to give to us to really make those determinations. There was a lot of things as I was going through that I was taking notes where I'm like, I need more information here and there. But this gives you an idea of what they're telling you. But at this point, that 19 to 22, I would say, is irrelevant because it's just their guess, and we need to know how they put that together before we even know that it's
right.
If it's realistic or not. The other things that it does tell us here, so targeted a 10-year hold with a 5-year cash out return. That's probably the biggest new information I got from this page, was that, hopefully we're going to get a cash out refinance in year 5 to get our money back. And then they're going to hold for another 5 years before they plan to sell at about year 10.
Agreed. And it gives us a little bit more information on what the conversions are from retail and mill conversions. From that, and I don't know if they really dive into this much later, I certainly always worry about zoning and entitlements. And I think that's something that is a really huge risk. So the hope would be that they are already entitled and zoned to be able to be converted to be self-storage, because you don't usually want to take that kind of risk. It's very binary. So that would be a big question coming out of that. And then also conversions, I think, for self-storage is probably much easier and more cost effective, but they can be more costly than actually ground up development. So I would certainly get some clarity around that too, and why they've chosen to go this route versus pure development or acquisition.
Those are good points. An example, again, all right, so nice pictures. Yeah, so this is the brand they use at the storage itself, right? Is that also the property management company as
Yes.
the brand?
hmm
Right, okay. How would they do this for other third parties? How would they be putting their brand name on a different property that's not theirs? Does that happen?
It can, yeah. It just, you'd have to check with them and see what that looks like for the
Right.
outside.
Yeah, and if they have a reputation in the space, it could be a benefit to third parties to have that name brand rather than just a random self-storage.
Right. This is really high level stuff. I don't really know if there's even much to talk about this, right? Like, there's no meat here.
No, I think that chart on the left is extremely unhelpful. They don't even explain how they're getting to these different levels or what any of that means. So that's super unhelpful.
Yeah, the only things I pulled from this, I would agree, the targeted returns stuff, it doesn't help us. And that's, again, the beginning of many things that they don't give us enough information to get any value from it. But we do hear in the language on the right that they've closed on their first property and they've got the second one under contract. And that, they're talking more about, just the returns, heavy value add, that kind of stuff. But it starts to give you a few things that way. So that lets you know that you need to check on it, and that the first two properties I think are in North Carolina, which is in their target zone of kind of what they gave us that their normal market is.
All right. So their timeline are they talking about buying one deal, buying all the 4 to 6 properties in the fund? Again, this for me was a bit high level, too high level. I don't
Yeah, it doesn't really tell you how fast they're planning to do these. And that's one of the things that you'd want to know. What do they have the capacity? Since it's an in-house construction crew, do they have the ability to do 4 to 6 projects at a time, or do they need to do 2 at a time? And how long is your money going to be kind of tied up earning just the pref over this? I'm assuming that this is each project's timeline, but we don't really know that.
Yeah, and I think also is that 10-year timeline starting from when you close the fund, or is that 10-year timeline on a property by property basis? And yeah, as you said, is there any kind of expectation or requirement on when these funds need to be deployed into these different deals? A shorter timeline is better because you get the money to work, but also worse because you could be pressuring them to go into the optimal asset.
And this is sort of where they talk about the different classes of shares within the fund.
Yeah, this is, again, they give us no details on splits at this point, and I didn't find anything on sort of the splits after the preferred return anywhere in there. At this point, we don't have any information on fees. The biggest thing I got from this was that, class B is at a 6 versus if you get into class A, you're at an 8%, but we don't know if the splits change or anything else. I couldn't really tell by the math what things are, or even be able to tell enough to determine it, which from a deck perspective, it's just, this is a horrible slide. It's just, they need to give us that information. I'm guessing that it's just, they don't know what an LP needs to make the assessment. But then if you want to go, otherwise they're trying to hide something. It's either that the splits are bad, fees are high, and they're trying to like mask that and not make it apparent, or they just don't know what we need to assess it. But it's frustrating as an LP to see slides like this in a deck, because you just need so much more information.
Yeah, completely agree. And I think one thing to point out is preferred return can be thought of in almost 2 different ways when it comes to real estate, especially of, is this a current pay pref that I'm getting where I'm actually receiving some of this income, and it's almost like a kind of hybrid debt security, or is this just truly my long-term preferred return where I'm getting that 6 or 8% long-term before they get their carry? But since there's no information on carry here, it's pretty much irrelevant.
Yeah, but basically what you're saying is that we should not assume the pref is the cash distributions.
No.
Right.
2 different things, right? And they're not mentioning the cash flow from this. It might be 6% or 8%, and it might be a lot lower, a lot higher than that. And the waterfall is also something I want to assume they just didn't think about adding it here, and I don't know why, it's really weird. But overall, they have 3 classes of shares, right? With different minimums, and each minimum, the higher you go, the better your terms are in the deal. Because A and A plus is the same pref, and the IRR is different. There has to be a better, split.
Yeah.
So, I mean, there's no other way to achieve it, right? It's not like they're going to, that's the only way to have better terms.
Right. But why not give us that information so we can see
100%.
it?
Yeah, you're right. Okay.
The other thing that this clarifies is then on a couple slides ago, we saw that they had a $30 million target for the fund. We were assuming that that was the total size. Here, they make that clear where they're raising 10 million of equity. So then that lets you know they're going to be about a 65% LTV, they think. And then the only other thing for this that I would come away with a question is that if you are part of a group, will they take aggregated things through a group of investors to get into the A or the A plus would be another question that I would ask.
Great. I think these are important points. All right. This is the first property they found in this fund, correct? I mean, there's not a lot of data around it in terms of like this is really high level, what they expect. Is this for this property or this is the fund?
See, that's the thing. They don't really tell you.
The footnotes, they say it's based off of this property and the second one they have under contract, or maybe that's something.
I think that's what it was, is a lot of these are based off of those two as examples for the whole fund, but they don't tell you, is it the entire fund, which I'm assuming so, or is it just, they're so light on details and there's no numbers like the slide before. This one has some numbers, but they're just not enough detail here to be able to use the numbers. And that's what I found this deck just very frustrating, because I really think these guys know what they're doing. They just don't understand what an LP needs to be able to make an assessment on it. One thing that I would comment on is there's a kind of couple of different ways when you're doing a conversion, because as you see in this case, they're not topping the units. And I think that you need to be aware of that, because some people, they're not going to be concerned, but other people will be concerned with that. And so I think that that's going to change what you can get as far as your rent potential. And so they unfortunately don't give us any comps, but you would want to make sure that if they did give you comps, that the comps were for something similar. And if not, I would be decreasing it back, because there's going to be a significant number of your people that are putting things into storage aren't going to be uncomfortable with just some chicken wire mesh at the top.
Okay. All right. Their exit plan, which they've already went directly to that. What can you even say about this?
I would say one thing is a refinance isn't an exit. I mean, it is a capital event where you are getting some capital back, but it's not a full exit. So while that may happen in year 5, I certainly wouldn't say that is the case. I would also really want to dive into their experience being able to execute very attractive recapitalizations and in which kind of market environments. As we know, I mean, the last several years particularly have been really difficult for sponsors to go and get debt at attractive terms. And so I would want to dive into what their experience is there, kind of who their banking partners have been, and how that's happened in the past.
Yeah, I do like that they give us the sensitivity of the cap rate. What they're not giving us is any sensitivity or the assumptions that they have in on what rents they're going to be able to achieve or the occupancy, which are both super important, but they just haven't given us those details. The other thing that I would come away from this is saying, how do you justify a 6 cap as your expected exit? That may be fine or it may not be, but they haven't given us enough information. And I found it extremely weird when we get to the later slides with the examples of properties that they have, that they're telling you that they used an extremely different cap rate on all of their examples. They used a 16.66% cap rate on every one of the examples later. And so it's like, why, it's just, there's no consistency there. They're not even close.
Yeah, I'd also say giving things in just dollar values is not extremely helpful for an investor. Like, go ahead and give us percentages of what this looks like on a return basis, just because there's no reason to make your LPs go and do the math on the back of the napkin.
Exactly. Well, and everyone's going to be in at different levels and that kind of thing. It's like, you can't do the math, and it's going to be different if you're a B or an A or an A plus. And so, yeah, it's just, I just found myself very frustrated with this because they're trying to give us the right information. They just don't know what to give us.
Yeah.
I feel like that's a common denominator in this deck, frustration.
Yeah.
Because you feel like there is something there, but it's like, all right, show it to me already. Like,
right. Yeah. I mean, Litan, we've reviewed some decks where you're just like, these guys don't know what they're doing, that kind of thing. And there's been other decks, but I really don't think that's the case with this. I think this team, it seems like they know what they're doing. It seems like they're trying. They're just really missed the mark on what they're putting into their slides, and they need They need somebody on their team that knows what's up and knows how to deal with LPs and has ever been an LP. And it's just very evident that they haven't been. And I had the same thing when they presented live at the Best Ever Conference, when I had to go talk to them afterwards to ask just some basic questions from them.
And they're still like expanding on the exit strategies. And I completely agree, Kaley, with the refi should not be an exit. It should be de-risking your position, because basically you cash out, but that's not an exit. You didn't take the risk to de-risk. And also, it's on the flip side, especially a year ago, if someone was talking about refi as even an option, it'd be a joke. Like, all right, interest rates are going out. You should not even talk about refinancing. But now in the current market we're in, where there is a probability of rates going down, then it's okay to talk about refis, just in a very different context, I think.
Yeah, and even at the beginning, when they say that 5 years, when you're getting 100% of principal back, I would want to see, especially you're out here in this environment, that is one of the options, but that shouldn't be the set in stone plan, because we've certainly seen sponsors that follow the plan because that's what they said, even if right now, yeah, that would be crazy. That's not what you would usually do. So I do think that's a bit of a concern, maybe.
Yeah, and I don't see it a lot, but I do think it's sort of like bonus points to the sponsor when they give us that, hey, here's our plan, but if we can't refinance, this is what the cash flows are going to look like. This is how things are going to be, because that's an option, and that's something. So I don't see it as often as I would like, but I always appreciate it from a sponsor if they've done that. And that's one of those things that I ask them for before I invest if they haven't, because they should have those numbers. They just haven't included it.
Well, they do give some sort of like alternative plans here in this slide, right? I mean, they do say, hey, I mean, if we see that the market is going to change or whatever, the shit hits the fan, worst case, they sell upon getting, the certificate of occupancy, right? Not best case scenario, but they do talk about the other options that are on the table.
They do. And as we go to the track record, I think we'll see, I didn't see, at least, once again, it was not super descriptive, but I didn't see examples of them actually executing exits, and definitely not at multiple examples of both.
Right. So these are just some examples of simulating, like a lot of others do, just the cash, like the investment and what it will look like and the sensitivity analysis. Do you guys want to dive into this, or is this like?
Yeah, I've got a few things from that slide. I mean, the first thing, this is the first time they talk about depreciation. And so they mentioned bonus depreciation. So it sounds like they're going to do a cost seg. But again, they don't give me percentages. And what I would like to see would be percentages. What I'm assuming from this $1 million example, where I'm going to have between, I think there was some place where it was 80 to 200,000. Well, that's an 8 to 20% basically depreciation rate. So just go in knowing that it's extremely low, which self-storage is one that I see all over the board. Sometimes it's really low like this. This is even low for the low end of self-storage, in my opinion, on the depreciation. And then there's some that they're using more of everything inside the shell is movable. And so therefore that all can be depreciated. And then you get some higher depreciation rates on some of them. But it's just, they give us information here, but it's very hard to follow. I can't really see where things are at. The only other question that I have besides that is, like, on all of their examples, they have the year 4 cash flow dropping significantly from the year 3. And I don't really understand why that would be. I can see that what happens in the other years, but I'd want an explanation for what's happening there. I'm assuming it's going to be that they've had interest only loans that are happening for the first 3 years. And then now they're flipping over and they're paying down some of the principal in year 4, but they don't give us the loan details anywhere in this deck. Later on, we find out that I think it was a 65% LTV is about what they're looking for, a range of 6.5 to 8.5%. But debt is a huge part of these and what works. And you need to understand, what does their debt look like when they're doing the construction? What's it going to convert over to once they have the certificate of occupancy? Or are they going to have to get new debt? And I want to see all that spelled out, and they don't give us any of the details we need to know if we're at risk because of the debt.
Yeah, I completely agree. Once again, same thing. They're giving us dollar values in a lot of this, which just is not very helpful. I think you're right. You definitely need to provide more assumptions to all of this for any of it to be meaningful.
I mean, well, they're actually stress testing this in terms of like different outcomes.
But they don't tell us what it is. So it's just random numbers. There's no details. Like what I would want to know would be, tell me what your plan is. And like your plan is to get this amount in rent. And then it's this amount of occupancy. And then it's this cap rate. And if you got that, that's going to be your expected. If then you tell me what each of those numbers are in the overperformance and what each of those are in the underperformance. And then I can assess whether it makes sense or not. And it is actually an underperformance. I mean, but just random numbers thrown onto a page don't give me any information. They're trying to, but they just don't give me the right things.
Right.
Yeah, I completely agree. And also, just in general, when I look at sensitivity or scenario analysis for most any deals, I always assume the underperformance case is probably more of a base case, and there's probably more downside there for a real underperformance case because assumptions are typically aggressive. It's just the nature of the beast.
Are you saying the underperformance is not aggressive enough, not conservative enough?
Not conservative enough. Yeah, I think that's quite often what you see of underperformance is typically closer to maybe a more normalized base case in my mind.
Yeah, especially when it comes to this isn't straight up development. This is what I would say kind of like a notch below development and closer to development than it is a heavy value add, because you're completely reconverting this. And when I look at development decks, I always put in an assumption that things are going to take longer and cost more. And then I have to run my own thing. So if they say I'm going to get money back in 5 years, I assume it's going to be 7. And if they, just, it always happens. I've never once been in a development deal where things came in on time and at what the cost they said. Have you, Kaley?
No, never.
Yeah.
And that's
so it's
great.
like,
To your assumptions that you were saying earlier, I would 100% add the timing of when things will be finished or occupied. All of that always takes longer than they think.
All right. Okay. So this is sort of the overview of the fund. Portfolio they want to raise, value of projects, and then financing. And then they are laying out the fees here.
Some of them, yeah. I feel like there's definitely some missing. The property and asset management fee being 5% plus an acquisition and disposition / refi fee. This feels not completely unreasonable, but certainly on the higher range of what I would like to see. And then this goes back to what we were saying with vertically integrated of I want to make sure that these fees are all you are paying to your property management and everything else. And there's not additional costs that are hidden in there because they don't have to disclose expenses the same way they do fees always. So that's always a concern for me.
Exactly. Finding out when it's vertically integrated, what salaries are billed directly to the project, which it's typical that if you have a manager that's at only one location or a maintenance person only at one location, that location is going to pick up the full cost. But I typically want to see that any regional or corporate people are all under that 5% property management fee, and you're not picking up any of the costs there. Little things like total capital raised versus the project versus the financing, they don't add up. So where's the other $2 million coming from? A huge part of this that I think you really would have to know about is what's happening with the construction, because construction is a huge part of this, and it's an in-house firm. Are they doing a cost plus? How are they bidding it out? How are you getting billed? Because if I was setting this up and I wanted to, I could just charge an absorbent amount on my construction company, make all my money there, and suck out most of the funds. And so I would want to know exactly how that's going to be billed out and make sure that I felt that it was fair. And they don't even mention it, because some people will do cost plus a fixed amount. Other times where they'll come in and they'll say, okay, we're going to take a fee of this to sort of, manage it and that kind of thing. But that's a big red flag. This is the first time we start to see anything about debt, but we don't really know, is that realistic or not? And then the other thing from here is they do tell us now that the first property closed in September of 23. So Litan, like you said, this may be an old deck. They may not be raising anymore. But if this gives you, whenever you're looking at it, you could say, okay, now I can start asking questions about that project. Are they on time? Are things going? If it's been a year like it is now, or a little over since then, if they were still raising, then you might be able to find out what all is going on with other projects that they haven't updated the DAC, but they may have all of their things identified by now. So lots of things to ask questions about.
Yeah, and I would add on the debt that it is very unlikely you're getting that 25-year term during the construction period, there's probably some construction financing and things like that, which they just don't even mention there. So I think, once again, as we said, diving into that is very important. And then during or down in the structure point, it is saying that each property is going to be a new LLC. And so each investor will be a member of those individual LLCs, which is unusual for a fund structure. It sounds like there won't be any commingled vehicle. You will be going into each of these LLCs individually, which also means that the operating agreements for each of the LLCs could be different. You would really want to check on all of those. It gives them a lot more flexibility to add in new terms or differing things with each different fund, and a lot more probably reporting, legal kind of review. And so I definitely don't love that structure when you're thinking of a commingled fund vehicle.
Hey, Kaley, I couldn't really come up with why they're making it more complex, because if they had it all one, they could still sell off one property at a time and keep others, correct? And so
Yeah.
what do you see as the advantage, or what would there be?
My guess is that it's a lot cheaper for them doing these individual LLCs rather than what most firms do is probably have an LLC for each individual, but that owned by this commingled vehicle. And so, one, keeping it in LLCs changes the ownership structure rather it being an LP vehicle. They have a lot more restrictions around if you have that kind of vehicle. An LLC individually is much easier for them to manage. And it sounds like that's what they've been doing in the past. I think this is their first kind of commingled vehicle. So this makes it easier on them if they're just doing the same kind of thing rather than having to manage a different structure.
Doesn't that mean they have to create K1s for each of those LLCs and then roll them up to the top and then create another K1?
Yeah, well, that would be more work for them, much less work for the investor. But I think the investor in this case is going to have K1s for each individual one.
Right. Which sort of defeats the purpose of having a fund.
Exactly.
And yeah, you don't get the structural benefits. It makes me think your preferred return is not going to be this European waterfall where it's across all assets, because they have no legal connection to each other. So I don't know how you could possibly make that your preferred return, which is much more beneficial in case one of these goes wrong. You know, you could not allow the incentive fee to go based on one good property if other ones are going bad, if it's this European waterfall. So I doubt you're getting that here. And then you also no longer get to say, I like this property and don't like this other property. And so you're kind of giving up a lot of your flexibility and your ability to underwrite each of these properties to go into a blind pool that doesn't really have the structural benefits that you typically get with a diversified fund.
By the way, it might be terminology wise, and that might not even be what they meant when they wrote this. It might just be one fund that holds 100%, like that fund or the holding company holds all the properties in a different LLC, and it might be the common what we're used to, and just like terminology here might be different. I have a question to you guys though about disposition and refi. I mean, and I might be wrong here. Is it common to take a fee both on a disposition and on refis? Because if they do multiple refis throughout the holding of this, like I haven't heard about fees from refis that much.
I don't love it because I mean, anytime you're taking fees away, it's coming out of your pocket as an LP. But I do see it probably half the time, I would guess. What do you think, Kaley?
Yeah, I'd say probably half the time. I agree. I really don't think those are necessary, and I think that the asset management fee should cover that, because in my mind, that is part of the financing side of things, which is how I view that fee. I think it's a silly one to have, but it certainly is out there.
Right. All right. Let's move on.
Now.
Right.
The market itself.
Yeah, this is where we first see that there's nine properties. And that's where I was doing my math. They'd have to each be worth 14.4 million if they had them themselves. But I think what I missed when I looked through it the first time is the number of doors. And so I think it's like they probably have twice as many to get the assets under management. So these guys are probably more in the 50 to 70 million range of what they own.
But they are pretty concentrated in like a region, right? They're not spread across the U.S. like other funds we've seen. And that's an advantage.
It can be an advantage or disadvantage. It means that this is their expertise, and it would be highly unlikely for them to ever go outside of that. So if this market becomes less attractive compared to other markets across the U.S., they're not going to shift their focus because that's not where they have the expertise. And so
Fair enough.
have a lot of good local experience, but at the same time, you're not kind of deciding relative value.
And this is also where you could go in and try to figure out, are there current properties in what you would consider a high growth market? And look at it, because likely what they're going to do in the future, I mean, the first two that they've put into this fund obviously tell you a lot. So that's going to be your biggest determination. But then the other 9 that they own tells you what they think a high growth market means. And that's their hunting ground. And so then you have to decide, is that something that you want to be investing in?
All right.
And I would also use this to go and search what the delivery of new self-storage has been, because that's been massive recently, and make sure there hasn't been huge amounts of delivery in these areas too. Otherwise, you're going into an already oversupplied area possibly.
Yeah, I don't think they even touch on that, right?
I don't think they do. And honestly, there's like self-storage, as I was saying earlier, is also a counter-cyclical industry, which is one of the biggest pushes for it. And I don't think they say any of that anywhere in here, which is disappointing.
Yeah, they had the one slide that showed that that self-storage lost less than other asset classes, but that's about the only thing that they had related to it.
Right.
In the last recession.
And then we go into the track record, which is just a lot of pictures.
Yeah, go back though to that first track record one. I mean, like using that as an example. So one thing is that they ground up development in 2006. So that does let you know that they've kept this thing a long time. I mean, that's 18 years ago, and it's been 15 years that this has been stabilized. The other thing is that this slide is the first time that I started to see what they're using as a cap rate.
But also, how are they coming up with these current values? I mean, they, once again, don't give us comps. They don't give us anything of how they're valuating. Did they get a third-party valuation, or are they just throwing out numbers there?
The comps are what are missing here again, because like if there are other examples, it'd be great to prove what they're saying here, right? Like, all right, have any of these gone full cycle? If there are investors in these, what were their returns? Did you refi these at any point? Like, there's so much information that you could, I mean, I'm sure they have this in their spreadsheets, but just show it to us so we can understand, because there's so many examples of deals that they've done. And we've done a lot of decks. You don't see these many deals that people have done.
So there's only one that they give us occupancy on too, and that was 75%. The rest of them don't have occupancy, and those are all things that I would want to know. In this one, they don't really give us enough information. Is it at 75% because it's just done and it's on its way up, or not? But it's like, it doesn't tell me enough information to know is that good or bad. Because if this is a stabilized product and they're only at 75%, then I would say that's pretty bad. I like to see things in the 90 to 95 range. But yeah, again, not enough information to know.
Right. Kaley, anything you want to add to these, like these slides about track record? Anything you noticed?
Yeah, I agree with everything you guys are saying. They're missing kind of the most important information within here. They also don't give what their goal was originally. Are these all just the buy and hold strategy? Are they planning to exit at any point in the near future? I didn't see any exits within here. One other thing I would say, and this is purely going off of pictures, so take it with a grain of salt, but it does not look like these are in super high density areas or anything like that. And one of the more attractive places to look within self-storage, especially with development or conversion or anything, are these infill locations where it's harder to build more, because self-storage is really easy to build. So if someone can come in and take a lot next to you or in the close vicinity, that's not a difficult thing for someone to come in and build.
Right. Yeah. All right. Then I'm going to the market itself and like why they think this is a good industry. Anything here you guys noticed or that is interesting to talk about?
Mm-mm.
Okay. So, I mean, we can wrap it up.
The next slide that had something that was interesting was 49, where they're talking about you can use qualified money.
Right.
And that's where I would want to talk to them about, do they understand UBIT and UDFI, and am I going to get charged anything? Do they have a blocker corp in place? If they don't, what are their current investors seeing with that, and how are they not having it, because they are putting debt on these projects? So that's something that, you want to make sure that they as a sponsor understand and know, and you're not going to end up getting in a situation where you're taxed. You get a high tax that you weren't expecting.
Right. No, it's also important. You also don't see this a lot. They say in your face, hey, you can do this, do that account, and have the tax benefits.
Yeah. Is it a good idea?
It's a little weird too that they are pushing this so heavily, and even saying you can reach out to us with questions and we'll connect you to someone who can help you set this up. That's all a little odd to me and bordering on advice on investments or recommendations and stuff. So
I think they said at the beginning, they have these disclaimers, right?
they do,
say,
but I just think that's an odd thing. Not a huge deal, just strange.
okay. And then this is the conversion, like, all right, hop on a call and start to invest.
So yeah, there's no, I mean, what I think one of the biggest things is there's zero discussion about splits all the way through. Even when you've got that thing where you know that there's 3 different levels, they're not telling you about splits. And that's something you have to know as an LP. And so, it either is something they're ashamed of and they're trying to hide, or they just don't understand that people need it. But either way, it's not good. And they're so light on the plans. There's just not a lot of detail to understand what any of the assumptions are. I like the idea. I'm not sure that I love the markets, but I like the idea of what they're doing. But they never gave me enough numbers to try to figure it out if it makes sense and if it would work or not. And so it's kind of I like the team, and some of the projects, but I don't love the deck.
Yeah,
Right.
I think that's all a great point. And I would say, like, track record and the team itself is one of the most important things, especially in these blind pool deals. And you definitely want to see if there's any key man risk and figure that out. And then also, this is meant to be an income play. And so thinking about not only within real estate or within self-storage, is this a good deal, but is this the best risk-adjusted return and yield play across different investment types?
Right. Yeah. I mean, again, we're missing information. There are a lot of questions to ask. Not saying this is a bad deal. There's missing information in the deck itself, and you always want to ask those questions. I wouldn't say red flags. I'd say just like questions to be asked.
Yep.
All right, cool, guys. It took us a long time to get through this deck, but I think it was an interesting review.
51 pages. It's a big deck.
It is. It is. Mike, Kaley, thank you so much for joining us and giving us your expert insights on this deck. And for the rest of you, thank you so much for joining us. And until next time, keep investing wisely.